Hi guys, welcome back. This is Dr. Satpute from Stock Market Files. In this video, we are going to discuss what is synthetic futures and options. So, sometimes there is a problem of liquidity in the market. So that time we go for synthetic futures and options. So before going into the detailed discussion of the synthetic futures and options, let us see what we mean by bullish and what we mean by bearish, right? When we are bullish on the market, that means we feel that market will rise, right? The prices will go higher. That is called as bullish view. Bearish means we feel that the market will fall, the prices will fall. So that is called as bearish view. When we are bullish, we buy call, we put sell, or we buy future, right? So these three things are done when we are bullish on the market. When we are bearish on the market, we buy put option, right? We sell call option, right? And we also sell future, right? So these three things are done when we are bearish, right? So let's continue our discussion about what is synthetic futures and options. Now, before going into the formula, let me show you something, right? If you look at this graph, this is a payoff graph for uh, the call option, call buying, right? So we are buying a 15,000 call option here, right? Which we are buying at rupees 200, right? Now we have already discussed that this payoff graph. Uh, according to the break-even formula, according to the break-even formula for call buying, as we are paying rupees 200 for buying this call option, right? So our break-even point will be a strike price plus this premium, right, which will be 15,200, right? So above 15,200, this call option will yield unlimited profits, and below this 15,200, we will have a limited loss, that is at the max, the premium which we paid for buying this call option. Now, this graph is a graph for selling a put option. This is a put option seller's graph. Now, the break-even point for this put option is the strike price. The strike price minus the strike price minus the premium which we paid, right? Which we got, right? So that is 14,800, right? 14,800. It's a break. It's the break-even point. Now, above 14,800, we will either be having a small loss or small profit, or at the max, the premium which we got by selling this put option, that is at the max 200. Our profit is at the max 200, but below, as market falls, right, below 14,800, our loss as a seller will increase drastically, right? Unlimited loss we will have. So this is a put option seller or selling graph, payoff graph, right? Now, let me show you a future graph, future payoff graph. Let's say we bought a future at 15,000, Nifty future at 15,000, right? As market price rises, we will get unlimited profits, but as market falls, we will get unlimited losses. That is future, right? Now, if I combine these two graphs, this call option buying and 15,000 put option selling, if I combine this graph, I'm going to get this graph. I'm going to get this graph. That means rather than buying future directly, I can buy a call option and sell a put option, right? So, so buying a future buy is equal to buying a call option and selling a put option, right? So buying a call option and selling a put option is equivalent to buying the future. So if I don't want to buy a future directly, so that time I can buy a call option and sell a put option. So this thing which equivalent to this, right? So this is equivalent to this future, right? So this future is called as synthetic future, right? So this will yield the profit or loss exactly equivalent to this future, but it's not a future actually, right? It's not a future actually, right? We are making future from call option and put option, right? So that's why it is called a synthetic future, right? So having understood this graph, so let's try to understand. So future buy, we saw the formula for future buy. So future buy is equal to call buy plus put sell. This we deduced from a graph. This we understood from a graph. This we verified from a graph. Now, if I want to sell a future sell is equal to call sell. In future buy we had call buy. In future sell we will have call sell, right? Here we had put sell. Here we have put buy, right? So just opposite of this, right? Because this is a future buy. Now for a future sell, just make it opposite. So call buy, call sell, put sell, put buy, right? So that is how we can deduce the formula for future sell. So this is synthetic future formula, synthetic future, right? So we are making future formula from call and put, right? Okay, now if I want to deduce the formula for synthetic call buy, right? That means I don't want to buy a call directly. So what other transactions can I do in order to make it a call buy, right? So from this formula, right, I have a call buy. If I take this put sell on the LHS, right, this left hand side, this is the right hand side of this equation. If I take this put sell on the left hand side, I already have future buy here, so this put sell will become put buy. So this put sell will become put buy. So call buy is equal to future buy plus put buy, future buy plus put buy. Now similarly, call sell. Now just make this opposite, because call buy, call sell, future buy, future sell, future buy will become future sell, put buy will become put sell, right? So this is the call sell formula. Now what is the this thing is called a synthetic call option, synthetic call option, right? So this was synthetic future, this thing. Rather than buying future directly, we buy a call and sell a put. So this is called a synthetic future, synthetic call option, right? Now formula for put buy, right? Put buy is equivalent to, if I from this formula now I can deduce the formula for put buy. I have a put buy here. I want to make the formula for put buy. Just take this future buy on the left hand side. Future buy will become future sell. Here it was future buy. If it goes on this side, it will become future sell. So put buy is equal to call buy, this call buy plus future sell, right? So this is the formula for put buy. So this put, this is equivalent to put buy. So this is called a synthetic put option, right? Similarly, if I make the formula for put sell, now just put sell is equal, just make it opposite, call sell plus future buy, future sell becomes future buy. So the note here is call and put must be of same strike price. Call and put must be of same strike price. Now, how can we remember this formula? How can we remember this formula, right? So here we had this original formula. Future buy is equal to call buy plus put sell. Put sell means minus P. Put sell means minus P. Call buy plus C. Put sell minus P. Right? Now from this formula, if I want to now if you want to sell future, just multiply this equation by minus sign on both sides. This plus will become minus, this plus will become minus, and this minus will become plus. We'll get the formula for future sell. Now for formula for call buy, we have already deduced call buy is equal to, take this put on the left hand side, it will become plus F plus P, right? Now for minus C, just multiply this equation by minus sign on both hand side, you will get the equation for call sell. Similarly for put buy and put sell, you can deduce the equation from this one, right? So we have here plus P is equal to plus C minus F, right? Okay, so now the point is, how will I remember this, right? One thing is you need to remember only this equation. Other equations can be deduced very easily. But if you don't want to do that, if you see in these equations, especially in these two equations, right? If you have call by, if you are making a formula for call by, in the formula for call by, I have put by. In the formula for call sell, I have put sell. In the formula for put by, I have call by. In the formula for put sell, I have call sell. That means if you are making a formula for call buy, you are buying put. If you are making a formula for call sell, you are selling a put. If you are making a formula for call put buy, you are buying a call. You are buying a call. If you are making a formula for put sell, you are selling a put, right? So so that's how you can remember, right? That means if I want to make a formula for call buy, so what will I do? If I want to make a formula for call buy, so plus C is equal to, you have to buy the put, that is for sure, right? Now what about future? It's call buy means your view is bullish, your view is bullish, your view is bullish. That means you want to make you want this side, you want to make you want to you must buy the future, because future buying means bullish view, right? So plus F, plus F. Plus, because plus C means your view is bullish, you are bullish on the market. So you want to make a formula for bullish, right? So in bullish formula, bullish view, you cannot sell future, you have to buy future, right? So similarly, if I want to make the formula for put buy, so if you are buying a put, you should buy a call, right? Now buying a put means your view is bearish. In bearish view, future must be sold, right? So this is the formula for put sale, you can see here. Right? Sorry, put buy, you can see here, right? So put buy formula plus C minus F, right? And for formula for call sell, just multiply this equation by minus sign. Just multiply this equation by minus sign, you will get call sell and put sell formula, right? Okay, so in call buy formula, put is always bought and vice versa. Vice versa means in the put buy formula, call is always bought. In the call sell formula, put is always sold and vice versa. That means in the put sell formula, call is always sold. So that is how you can make a synthetic future. So this synthetic futures and options are used when you don't want to either directly buy the call or put or future, right? So these can be used to make a to hedge the position, or when there is less liquidity in the market, so that time you can use the synthetic future options. So thank you guys for watching. Please stay tuned.